G'day, welcome to the Financial Bloke Podcast, the podcast for people seeking the wisdom needed to grow their family's wealth and live a happier, healthier and more prosperous life. My name's Ben Law and I am the Financial Bloke. Welcome back to the Wealth and Wisdom Podcast. For many rural producers, 2023 was a bit of a shit year to say the least. Increasing input prices and interest rates alongside lower livestock or commodity prices. This, coupled with widespread drought conditions in many parts of the country, it was undeniably a tough period for many producers. If that sounds like you, the prospect of a tax problem might not be front of mind. But what if I told you a challenging year often presents opportunities for smart tax planning? And today, we're going to dig into those opportunities. Now, if for you the stars have aligned and you've had a cracker of a year, or maybe just a pretty reasonable one, and you will be seeing a profit, and hopefully lots of it, the decision you need to make is how much of your hard-earned cash do you want to give to the tax department? These are the conversations all good accountants should be having with their clients throughout the year. Whether it's to alleviate the tax burden when the time comes, or to capitalise on the opportunities that arise during less than ideal circumstances, proactive tax planning is paramount. Today, I've got accountant Russell Strack back on the podcast to talk all things tax planning. If you've never done tax planning before and you want to find out what it's all about, or if you have, or just want to see if you're missing anything, then this will be the episode for you. So before we kick things off here, I just want to be really clear that Russell and I are going to be talking about general tax principles and information. It's just general information. It's not personal information or personal advice in any way, shape or form. And before acting, you should absolutely speak to your accountant or professional advisors to get appropriate advice specific to your circumstances. I'm probably going to say this a couple of times during the podcast. I want to make that really clear. So without further delay, welcome, Russell.
Thank you. Thank you, Ben. Thanks for having me back.
It's my pleasure. I know you're a busy man at the moment with tax planning season in full swing. And, we had a huge amount of feedback on that last episode we did. Is it time to break up with your mediocre accountant? Which was episode number 38. And, if anyone's listening now and hasn't heard that, go back and do yourself a favor. Episode number 38. I actually thought, Russell, I was going to get a whole lot of hate mail from accountants. I didn't know whether there'd be a little financial bloke voodoo doll sitting in every accountancy firm in Australia, but I got some great feedback from mostly accountants coming back and saying, absolutely, we couldn't agree more with Russell. How about yourself, mate? Did you get any hate mail?
No hate mail. I actually didn't realise how far your podcast goes because a lot of accountants listen to it, I think, to get some technical knowledge themselves. And then they went, gee, we were waiting for you to jump into something technical. And I went, no. We're real people too, accountants. And that was a lot of the feedback that I got because you know me well, Ben, but I tend to talk from a personal perspective. And that's always nice to think about your accountant as a person that wants to get to know what you're doing. And we all do. That's what we love doing. That's what wakes me up every day and gets me energised to go to work.
And I think that's a fair point. I'd quite often give professional advisors a hard time. I mean, I'm a retired professional advisor for 20 odd years and I give them a hard time. But, I used to go to conferences and I'd meet a lot of accountants and bankers and brokers and lawyers. And for the vast majority of them, they're just busting their guts trying to do a good job. And the vast majority actually do care. And, we should really point that out. I think that's a great point, Russell. So
can I just say too, Ben, politicians as well. Ooh. It's interesting in different roles that I've had meeting politicians. You have a lot of obviously clients that give them a hard time, and then when they meet them and get to know them, their opinion is totally different. And most politicians I've met are doing it for the right reason, even though they may be poor on certain aspects of it. But you don't go into something like that unless you really want to help people. And I'm the same. That's what I love to do.
Yeah, awesome. Well, mate, today we're going to be talking the most exciting topic, tax. It makes every accountant get excited. I remember that there was an advert on years and years and years ago. You probably remember it. It was an H&R Block ad, and there was a lady typing away in the back office on a laptop, and she worked out she could get another deduction for her clients, and she's like, yes, and then went quietly back to typing. I think that's how most people sort of envisage their accountant is, but it's not like that, is it?
No, it's not. And for us, it's more a long-term planning aspect too. So people talk about, oh, I'm having a big year. What can I do to save tax in that particular year? We always take that longer-term sort of perspective, because all the decisions you make, particularly in farming businesses, have an impact. They have an impact on you financially. They have an impact on your capabilities in the years after as well. So it's always looking at the client, looking at their overall circumstances, engaging all of that. So it's never a one-off moment or I've no doubt you'll be doing some chat GPT or some AI sort of, people are thinking this is something that you'll be able to solve by just doing an AI sort of approach to it. To us, this is something that's a lot more involved than that, because it takes a longer term look at the client's affairs.
Yeah, because it's not just about tax.
No.
There's far more involved to it. So let's just kick off with a really simple question. What the bloody hell is tax planning?
Okay, so similar to what I just said, Ben, to us, it's structuring your financial affairs to control or manage your level of taxation. And having a tax estimate is one part of that process. The other part of the process is communication during the year as well about how you're going, what you're looking at doing. So I would always argue that if somebody's in a taxation position that they're not happy with, quite often that's because they haven't had conversations when some things have happened during the year to cause that result. So that could be being forced to sell all your cattle as an example, but it could be other things as well.
Absolutely. And it's interesting, I did an interview around the depreciation issues around capital equipment, so buying and selling trucks, machinery, graders last year. And there was a huge loophole that I think are going to catch a lot of people out, which we won't get into today. But, you have to have those discussions with your accountant as you're purchasing and buying and transitioning assets. You really need to have that discussion up front, not just leave it till the end of the year.
Yes, 100% agree.
So should it be left to the last week in June?
Definitely not. Personally, here's my personal answer. Last week of June is a rough week for us. You don't want to meet any accountant on the night of 30 June. We're generally not in the best of a state. So, no, you don't want to leave it till the end of June for your accountant's well-being, but also your own. There's a number of things that take time to structure. The most obvious example of that we're seeing at the moment is we've already had meetings with banks in our office with the senior accountants and the partners around this could be a year to be prepaying interest on debt. To set those things in place requires a fair bit of time. So those meetings we've already had. To give you an idea, the banks are coming to us saying, look, Russell, if you've got a client that wants to repay the debt on their loan quicker, lock in, fix some of that interest rate and get a tax deduction for the prepayment of that interest, we need to know by this date. So they're setting those expectations that it's going to take time. That's one example. There's a number of them, but I wouldn't be leaving it till then. We tend to time a lot of ours to the March BAS period. And Ben, what I would say is we try and get on top of our workload as much as we can by this time of the year. But to be honest with you, a lot of our clients like to have a look at the next year before they finish the prior year. A lot of our lodgement periods are timed to this time of the year for the previous year, for 2023. So it becomes this perfect storm of being very busy on a lot of your normal work out of the prior year and the estimate work into the next year. But we preference trying to get the estimates turned around very quickly, because the issue that you have is, let's say your accounting firm does your BASs for you, and let's say on the March BAS, they come up with some numbers to base a tax estimate around. The issue with that is if you then don't see your accountant until June, there's too big a gap between your March numbers and your June numbers, and people's memory changes or is, harder to nail down those numbers correctly if there's too big of a gap. So my suggestion to a lot of clients is to make sure, firstly, before you come in, make that appointment, that you've nailed down exactly what those numbers are. So getting those numbers right first is the most important thing. That could take a few conversations over the phone or some emails going backward and forward, but also make sure there's not a big gap between when you believe the numbers are done up to and when you're having the conversation around what the result is and what the options are. That's the way I would explain it, Ben.
Yeah. And that is a problem, it's the fact that for a lot of people, they're not lodging last year's tax return until that March, April, May time. And then that falls directly in line with planning for this year's tax before 30 June.
Yes.
And so you get this double, bit of a storm of work for them of going, well, we don't even know what tax we had to pay last year, let alone try and think about this year. So people get very reluctant to take on too much work. Is that a fair statement?
Exactly, Ben. And it's a reason to have your tax done as early as you can in each year. It's easy to say, no, I'll leave it till we do the estimate because I can deal with 2 years in the one time. The problem with that is if you don't, the estimate can become a priority, and it often does. And we understand that. For clients, 2023 year now is ancient history. It's done. It's already put away. You've probably had an estimate at that time as well to look at the 2023 result. They're concentrating, as they should, and most people would, on where they're sitting at the moment and what that answer is going to look like. The issue is if 2023 is not done, you can make a mistake very easily on where your numbers sit for 2024 if you haven't got 2023 up to date. Depreciation is a really simple example to that. But you don't want to spend a lot of time, effort, and money with accountants along these lines if you're not sure that the numbers are actually right. So quite simply, I think that's the most important part in the process, is getting those numbers actually nailed down to the right answer first.
It wants to be reasonably accurate, doesn't it?
Yes. And with a lot of ours now too, the clients, we've sort of developed a way with a number of our clients, particularly where they have tax issues in most years, around them getting an understanding of how we come up with the number at the end of the year. So not the answer to what to do with the number, but how we come up with the number. Now, we're doing that psychologically for the reason that they can then do some of the process themselves and see how they're going during the year to go, oh, I think I've got a problem. I know that I've got this much grain rolled out of last year, or I know the value of the cattle on my books is very low and it's only $20 a head. Whatever the answer might be, the better they have an understanding over that, they can identify that they've got the problem earlier. We don't have to be ringing them saying, we think you should come in for a tax estimate based on what we're seeing. They've already seen that they've got an issue because they're gauging it during the year, but they're using some level of knowledge around how you come up with that answer each year. With clients with a number of entities where there's transactions that happen between them, sometimes that's difficult. But to me, the client themselves plays an important part in the process, trying to work out the size of the issue earlier as well.
And there's a lot of things that can trip people up. I've just written a couple of notes down there as you're talking, which we'll get into briefly later, is like Division 7A issues catch people out all the time. Forced sales is another one I see when people have elected to do forced sales in previous years and all of a sudden it's turned up and there's nothing you can do about it. Delayed sales of grain, we sent it out at end of June but we didn't get payment until July. And also depreciation. You've been getting big depreciation over the years and all of a sudden you get to the end of all the depreciation because you haven't bought some machinery in a few years and you're like, holy dooly, we've gone from this really manageable tax position to a massive tax bill. So there's some real things that people can get tripped up with that you think, hey, tax is never normally a problem for me, or I've got this under control, and all of a sudden 2 or 3 things can just trip you, and next thing you know, you've got a major problem. And the one other thing just to pop in there too, Russell, is I see a lot of people is they'll do last year's tax returns, this year's tax planning, and a bank review at the same time. They're trying to get budgets through. And I had someone recently where the 3 things were happening in April, which is just a really bad position to be in. So this is really a funny one. And for me, it's an absolute obvious answer, but for most people, it's not. Should the goal always be to pay as little tax as possible? Today's episode is brought to you by AgriCoach. You've worked bloody hard over the years and you've built a solid operation. But as your children grow up and start their own journeys, you're beginning to think about the next 5, 10, and even 15 years and how to keep driving the business forward and ensure a smooth and successful succession plan. Preparing the business, preparing the next generation, and preparing for your eventual retirement all requires a solid plan and a proven process. Unsure about the right steps to take? Head on over to agricoach.com.au/webinar to learn more about our Succession Proof Your Family webinar. AgriCoach, aligning families, growing wealth, and protecting legacies. And now, let's get back to the episode.
Definitely not. And you'd expect that answer if you listen to my last
I know that. That's and I've had a few people, Russell, actually come back and quote that one about the would you rather earn 500, and I thought that was an absolute great statement.
Without giving away too much work product, I'll give you another example of one thing that I have done more recently with clients. It's difficult not to talk about examples. So this is not a specific client example. So I can give you this one. We do see, and Ben, you know that I quote quite regularly on new work, but we do see a number of clients come to us and they've got, as an example, a large amount of farm management deposits built up, and they'll come and if I ask the question, what are those farm management deposits most likely to be used for? Their answer will be, we want to buy another property. It's a long-winded answer to your question, but the reason why I'm asking the question is you really need to match pulling the farm management deposits back out against whatever the expenses are going to be, and particularly where those expenses are paid from and where they can be invoiced from for taxation reasons, which if we get a chance to cover, I can talk about. But the biggest issue that I have with that, and the reason why this answers your question about should you always try to pay the least amount of tax, is if you do a calculation around that and go, okay, instead of building up those large amounts of farm management deposits over all of those years, which seems like a really nice forced saving, is what if we bought farming country during that period using that money and paid the tax on it prior? Do a calculation on what you'd be worth today. And I'm sort of directly talking to some of your listeners, but if you've got a large amount of farm management deposits, go through the process. And I think you'll find that you would be a lot wealthier today if you had paid the tax and done farm management deposits certainly at times, but not built them up to an excessive extent where it actually makes it difficult for you to pull them out and pay the tax to buy a property, let alone the price that you would pay today compared to what it might have been worth to have access to the money to do that more easily over those years. So to me, that's a simple example, and I know that's a simplistic way of looking at it, but that's just one example that we see quite regularly, because clients like the idea of building up cash, putting it into a property, not gearing the full amount to buy the property. But when there's taxation on doing that compared to having already paid the tax in the past, it's a lot harder to actually bite the bullet and do it when that opportunity comes up.
Yeah, and I think that's a bloody good example, Russell. And there's a couple of things I sort of always look at it in this way is, number one is it's very hard to pay off debt if you don't pay tax. Generally, you've got to pay, in most cases, pay off your debt using after-tax dollars.
Yes.
And so sometimes it actually makes sense to pay the tax, especially if you're a lower marginal tax rate, and start to clear debt down if you can. The other one is quite often the strategies I've seen people make over the years is they just accumulate, for example, FMDs or forced sales, or buy more machinery that they don't necessarily need right now for the depreciation, and they're just kicking the problem down the road. So it's not actually managing the level of tax, it's just pushing it out to another year. And like most things, if you kick it down the road, eventually it's got to come back in. So that's where the planning comes in. And I remember the first time I think I met you, Russell, years ago, was sitting in a tax planning meeting with one of my clients. And we were talking about his old accountant had been telling him to put money into FMDs every year, and they built up. And I think, I'm going to paraphrase you here, but it was something along the lines is you should never put money into FMDs unless you've got a plan for how to pull them out. If you're going to go in, you've got to have an exit strategy at the other end, because eventually it's going to bite you in the ass.
Yes, that's exactly right.
Yeah.
And I think it's easy to look at a short-term solution without trying to gauge what's the long-term consequence. So that's easy, and that's easy for people to get their head around. So, but you don't want to become a farm management deposit and ingrain yourself in that as the one approach, the best approach to fix everything. It really is more about structuring, more about your rate over time. And I've seen a number of examples recently, particularly with deceased estates as well, where the farm management deposit raises its ugly head. And we have the ability to look back and go, what if? Because we've got the history of the records to be able to say, I wonder, would we have been better off doing something else earlier rather than taking that approach? So everything's easier in hindsight, as everyone says, but farm management deposits are an issue for a lot of people. And to an extent, I hear from farming clients as well, isn't it great I'm getting a return now on my farm's management deposits? And the obvious question of that is yes, but what interest rate are you now paying on your debt compared to what you were paying before. The most common question I get asked by farming clients, and this would be, 9 to 1 of everything else, is exactly what you said before, Ben, is how do I make my numbers look as good as I can so I can gear and do other things as well, but how do I also pay that off my debt? So to me, the cake and eat it too is doable, but it's around structuring so that you minimise the rate, still generate as much income as you can, and financing going forward is important. Just off on a tangent on that too, Ben, what I see over time, I've probably done this long enough to understand this, is our practice had a number of older partners who are fantastic on the tax planning side, but there were large advantages to kick tax down the road because the rates were substantially getting cheaper very quickly. So as an example, company tax rate going from 39 to 36 to 33 to 30 happened very quickly. We're probably at a period now where it will sit at 25% for an extended period of time. What's changed since I've been in a rural area 30 odd years ago is that the number of beneficiaries, so if you're trading as a family trust, the number of beneficiaries in your family group is not as big as it used to be. So you used to be able to run it, and I'm not sure you've probably covered this within podcasts, but the biggest change in these rural areas is there's less people. There's less people on more country to be able to be viable. The issue that has is potentially over time you're losing beneficiaries. So the opportunity, life cycle approach to, let's say you're trading as a family trust, distribute and minimise tax by spreading it across family groups, you've got to be careful when you're kicking tax down the track that you're not lining that up against a smaller family group than you've got today. And we see that if you look at an overall sort of 10, 20, 30-year period within succession and family groups as well, that there's this danger of kicking it down the tax but paying a higher rate on it because you've got less opportunity to split it. So I think that's something, those two things are fairly common things.
So Russell, I think a really important point to emphasise is to go back to where you said about the long-term goals. I think when you do tax planning, a mistake a lot of families make is they focus on this financial year for tax planning, whereas I think they need to start really thinking about what's our long-term strategic goal. Is it to retire off on the farm? So maybe superannuation could be a better option for us. Is it to expand? So we want to be borrowing more money down the track, so therefore reducing debt might make some sense. It might be we want to lower our tax rate this year, but we know we're not going to have a great year next year, etc. So it's about thinking about what is our long-term strategic objectives and then going, well, how should we manage our and structure our tax affairs now to get us closer to that objective rather than just minimising or reducing the average level of tax this year.
And it's one piece of the puzzle, Ben, but the reason why you have to take a long-term approach to it is that you certainly understand from the succession point of view, you can't jump in and go, now for a 3-year period, I want to prioritise putting money into super. Back when I started doing this job, you actually could do that, but you can't anymore. You're limited to smaller amounts that you can get in as lump sums unless you sell a property or something else. So it's more difficult now to plan very quickly within life stages of clients. You have to take that longer term approach because to an extent the government's forced you to. When I started on this job, from memory, you could put 130,000 each into super and claim a tax deduction for it. And now it's next year going to $30,000. That has a massive implication on building something up for succession or building some retirement strategy to do with the older generation moving off farm or reducing the tax burden of the group overall over periods. So the longer term approach has to be at the cornerstone, I believe, within the process. And the clients that I have where I've done tax planning over a number of years, they understand that. And when they come into the meeting, they've got that background already in their mind. So it is to some extent a quicker, easier process because they already have that level of sort of understanding built up that we're not focusing just on this year, we're focusing on the goals down the track.
And I think that's an important point to go back to again is that's a question an accountant should be asking you. You know, if you go into your accountant for tax planning, it shouldn't just be about, oh, this is your tax, this is what you could pay. If we do these certain things, this is the amount of tax you'll pay, and you judge them based on that. They should be saying to you, okay, what's coming up? What's your plan over the next 1, 2, 3, 5 years? Long term, they need to understand that before you can even start to look at what the options are, because option A might be to pay less tax. Options B might be to pay more tax, but you'll choose option B because it'll get you closer to your goals, unless the accountant knows that. Now, if your accountant doesn't say to you, what are the long-term objectives? What's happening next year, the year after? What's happening with succession? Are you going to expand? Do you want to pay down debt? Do you want to be building off-farm assets? Yada, yada, yada. You need to tell them. You need to articulate that across to them. You know, mum and dad are looking at retiring in the next 5 years or 10 years. That's a really important strategy. Succession's important to us. Wow, we're wanting to buy another property. You know, we know things are tight at the moment. What do we need to be doing to put ourselves in the best position to be able to expand and buy the neighbour's place if that's the case? You need to articulate it if they don't ask you.
Agreed. Quite often we'll ask the question because a client will say, I was told I needed to do this to get to that tax answer. The reason why they're saying it in that way is they're looking at it and going, I wish I hadn't have done that. They're actually saying it in terms of the main reason I did it was to save the tax as well, whatever it might be. So it's almost like the accountant is looking at it going, okay, this is the answer that I in my mind would like you to get to, that I believe is an acceptable level of tax for you, potentially not even understanding what that is. And then these are the different options to get into there. What would you like to do to get to there? That's not taking a long-term approach. That is in different years looking at what that option might be. So sometimes that might work, but in a lot of cases it doesn't, because the client themselves gets 10 years down the track and they've got a mixture of things that they never would have done based on where they were trying to get to by that point in time.
And it's interesting, I see a lot of people judge their accountant and the quality of their accountant on how much tax they pay. So I went and saw my accountant and I had a $100,000 tax bill, and, you know, he or she waved the magic wand and now I pay nothing. Isn't that awesome? My accountant's great. That couldn't be further from the truth. Just because you pay less tax doesn't mean your accountant's any better. I mean, there's plenty of accountants in jail over the years for minimising people's tax in illegal ways. Doesn't make them good at what they're doing. And it all's got to come back to what's the objective. So what does tax planning look like? Like, what are the options or the main options that people would actually take towards the end of the financial year? And just to be really clear, this is not personal advice. You should go speak to your accountant. You should get advice. This is just general information, isn't it?
This is definitely not tax advice for this point.
So what are the options, mate?
So the most common options that you'll come across, obviously, you started with the farm management deposit option with livestock, deferring livestock sales, superannuation itself, with what you mentioned before, so the lack of immediate write-off deductions, so the lack of actually buying any equipment or motor vehicles, etc., to do with farming. The most common option there now is looking at the prepayments. So what are those expenses that I might have running into the next year that I can prepay to an extent?
So fuel, fertilizer, you know, those sorts of things.
Can I get a bit of a discount on the price even potentially to go and do that, or get some interest on paying whoever that supplier is earlier? So those are the most common examples. Anything outside of that would be more tied into the structuring side itself. So anything outside of that is more around how it can be spread, minimised, etc., based on the structure, or things that you might have put in place in the past that then roll over into the current year. So, you know, that opens up a bigger range of sort of options, if you like.
Yeah. And there's obviously the one which you sort of touched on there, Russell, which was the structuring, which is the use of a bucket company, for the lack of a better term. Do you want to unpack what that is, mate?
Yeah. So just to explain bucket companies, depending on your structure, again, a lovely thing called Division 7A can become your issue. If you're structured as a family trust, which a lot of farmers are, and let's say you're trading in a family trust, if you want to access that lower 25% corporate tax rate, you could have a beneficiary set up under your family trust that is a company itself. The issue with that from the ATO's point of view is if the family trust and yourselves have access to that money, you might be using the money to pay off debt, but you want some of that tax result in your trust to be taxed at only 25%, then the ATO deems you to owe that to that company. So that is a debt owed to that company. There's an expectation it's going to be repaid over a set period at a set interest rate, etc. So being able to set and forget, access that money, use that money whichever way you choose and not have to repay it to that corporate entity or structure it in another way, creates this, what we call a Division 7A issue. That's if you're structured as a trust. More simply, if you're structured and you farm through a corporate entity itself, then that is simply you taking money out to yourself or your own entity through that company. So any monies you take out yourselves, personally, as an example, would be owed back to that company, and that creates a division, what we call a Division 7A loan.
Yeah, which a lot of people get caught on. I'm
Yes.
surprised how often you actually see that crop up. So realistically, the major options, just to go through and make sure I'm really clear, is we've got obviously prepaying expenses. So, go buy more fertilizer, fence posts, and you should always buy things you need, not stuff you don't need. There's always the hear of the farmers that go out and buy a whole heap of strainer posts, leave them in the shed, and then they rot out with white ants 10 years later. And, you don't want to spend a dollar to save 20 or 30 cents in tax, do you?
Can I pull you up on that too, Ben?
Absolutely. Yeah, please.
So that your listeners know. So buying a whole heap of fencing product prior to the end of a financial year is not a tax deduction. So you have to construct the fence itself. Similarly, we have a lot of clients who believe that purchasing cattle is a tax deduction. It isn't. So that becomes an issue for farm management deposits. Obviously, if you sell your cattle, put a farm management deposit on, and then want to offset pulling the farm management deposit out against buying cattle is not a tax deduction.
So you're setting yourself a landmine there where you've pulled out the FMD, because when you close at FMD, it becomes taxable income. So if you've got a $100,000 FMD, you close that out, the money comes back to your bank account, and then you've got to pay tax on that $100,000, or it's included in your taxable income.
And sorry, just on that as well, another multi-layered issue with that we quite commonly see too is your common structure of farming through a family trust. Farm management deposits can't be put on in a family trust name. So making a loss in your family trust and offsetting it with pulling farm management deposits out is not possible. You have to declare that farm management deposit in the individual farmers' names. So you need to be careful on how you structure and pay expenses and where from to be able to offset against pulling farm management deposits back out.
Yeah, that's a really important point, because most farming businesses now have got complexity. There might be a family trust, there might be a bucket company. So a bucket company is like, you might be ABC Family Trust or the Russell Family Trust. Then you might have ABC Proprietary Limited as a bucket company. It's knowing what assets are held with what entity and where the profit is and where the loss is. And if you've got losses in a family trust, you might not be able to offset them profits in a company. So you've got to basically work through all that. So the other option was superannuation, and obviously there's limits on how much you can put into super. You can't get that money back, so you've got to be really careful about that. We talked about forced sales, so that is there's the ability to, if you've sold a whole heap of cattle and it's in a drought declared year, you can actually push that out. The problem with that, Russell, correct me if I'm wrong, is you can only do that for a certain period of time. So I think it's 5 years, is that right?
Yes.
Yep. So 5 years ago, there was a drought on. Your accountant said, look, you've sold a whole lot of cattle. We'll just defer that for sales. And then all of a sudden, 5 years later, we're sitting there going, we have to bring those sales back in, and you might have done something 5 years ago, which has now got to be dealt with now, and you can't push that can out.
Yes.
Correct?
The other issue in Queensland that's a common one with that, Ben, which is worthwhile your listeners hearing as well, is if you've got older farming clients in partnerships, as an example, there's an issue with something like a livestock deferral. So partnerships in Queensland, unless you have a partnership agreement, don't have continuity. So to run an estate partnership and continue at something like a livestock deferral on after somebody has passed away is a problem in Queensland without a partnership agreement. So most good solicitors in Queensland, when they're doing older wills, particularly for partners in farming partnerships, would try and set in place a partnership agreement that would give some continuity to that ABN number in the partnership itself, so that livestock deferral can be passed on to the new partnership and handled over a period of time.
And that's the same with FMDs too, isn't it, Russell? If someone has an FMD, so let's just say we've put 400,000 or 500,000 in an FMD for, let's just say, Dad, and then Dad falls off the perch, that then all comes in one financial year. Is that correct? So that would be $500,000 worth of taxable income, and then you would get taxed at your marginal tax rate.
Correct. Please don't pass away towards the start of a financial year.
Makes it a lot harder.
Yeah, there's some tax structuring advice. Yes.
That one's real.
Yeah.
Try not to die is probably better advice, isn't it?
Yeah, exactly.
So you've had a good year. You've got all this tax to manage, but how do you take advantage of a bad year? Because that's one of the points I made in the intro is, people sort of go, I've had a bad year this year or something like that, which 2024 financial year or 23-24's, for many people, probably not going to look great with rising interest rates and dropped cattle prices. How can you take advantage of a lean year to actually benefit from it?
Yeah, as I just mentioned, Ben, often we spend more time with clients actually in those years because that's the years to actually plan as well, but also try and bring some of these legacy issues back in. So I call a farm management deposit a legacy issue. When you think about it, it's a dollar amount that is an unpaid tax figure. So trying to work out exactly how much to bring back in and then how that's going to be used is most important in those loss years, because you don't want to end up in the position in a loss year where you do something, so you assume that as a result of the year that you're having, that you can bring your livestock deferrals, as an example, back in, or that you can bring your farm management deposits back in, and then find you get that ugly tax bill still at the end of the year because you didn't think of something. So you might have, as an example, you mentioned on the podcast, the prior one about the immediate write-off ceasing, a client might buy a whole heap of fencing at the end of the year or buy an asset to write off at the end of the year and not realise that they're not able to anymore. So to me, a loss year or a harder year is a year where you structure to try and get rid of some of those previous legacy issues, which then sets you up better to be able to not use up all your cash in that better year, which might be the following year or the year after.
There's also some succession issues, isn't it, too?
Yes.
Because I know with selling of assets with capital gains and those sorts of things, there's certain thresholds. So if you've had a lower turnover year within your business, that can be advantageous as well.
Yes, an opportunity to transfer an asset, as an example, based on a lower year. Most of those small business capital gains concessions work on your turnover being under 2 million for the previous financial year. So gauging that and when might be a nice time to shift an asset for succession purposes is important.
So what about debts with the ATO? Russell, I really hate to see those in a client's position. They've got a debt with the ATO, and 9 times out of 10 I've found is people will go, you got this ATO debt. Why have you got an ATO debt? And they're like, I'll just pay it out over the next 12 months or 2 years. I'm not worried too much about it. But that can be a major problem, can't it? Especially with banking. So do you want to give us a few details around why that's a problem?
Yeah, 3 main reasons at the moment. Interest rates one. So your GIC now with the ATO is over 11%. So you're going to pay a hefty interest rate with the ATO. The other issue that we're seeing regularly now is trying to move banks as well. So banks don't take kindly to an ATO debt that's been racked up, even if you've got a payment arrangement sitting against it. More importantly, finance overall. So even if you go to finance that tractor now, they'll ring your account. They'll ask for a few different things. Normally your financial statements, but your portal reports. So your portal reports say whether you're up to date with all your ATO payments. If there's an ATO debt sitting there and there's no payment arrangement in place, it's generally very difficult to finance something. Debts themselves over 50,000 or over 100,000, depending on the circumstances, are reported to credit agencies. That now includes your ATO debt. So the ATO directly will report any debt over $50,000 or $100,000. Now, sometimes that can even be a timing issue. So there's a timing issue between when something might be lodged and paid. Those show up for a very short time frame, but are reported. I actually get a report now internally for all our clients where their ATO debt sits above $100,000. So we distribute that and manage that ourselves as well amongst the accountants.
Because it is a problem for banks. I know every broker and every banker I've ever talked to, if they see ATO debts, their credit analysts or their credit managers, it's a dirty, great big red flag to start digging more.
Yes.
And yeah, I just find it's a real problem. The other thing is trust minutes. That's another one which I think a lot of people have skirted around over the years. They haven't done them. They've sort of run the gauntlet. But if you get audited, it's a major problem. So can you just explain to us what trust minutes are and what needs to be done and what happens if you don't do what needs to be done?
Yes. So in simple terms, you need to, if you're trading as a family trust, you need to make a resolution prior to 30th of June. They can be in different formats, but you basically need to decide the way you're going to distribute that year's profit. That resolution needs to be documented and made prior to the 30th of June. The consequences of not doing that is you can be stung the highest possible tax rate, including penalties. There can be circumstances where, in that case, you can rely on a particular beneficiary to take all the income. But in most circumstances, the tax consequences is very large if the ATO finds that you don't comply within those rules. So good accounting practice would have a process around making sure that all their trust resolutions are done every year prior to 30th of June and documented correctly.
Because a lot of people get caught because, again, not knowing how people are structured. And I've done a few podcasts on these, but you might have a partnership, which is ABC partnership, and then you might have a family trust, which is, as we said, ABC family trust. But people quite often think they're a company. But what it is you've got ABC Proprietary Limited as trustee for the ABC Family Trust. And so they go, oh no, I operate as a company, which is ABC Proprietary Limited. It's like, no, that's just the trustee of that trust. You're actually a trust entity. That's the entity that you are doing business is the trust. And so at the end of the year, you've got to tally up all the taxable income, and then that entity doesn't pay tax. That entity disseminates or passes down those tax liabilities or that assessable income down to beneficiaries. And so the idea is you're wanting to distribute that money to the right people in the right places. So you might have mum might get distributed more than dad, or dad might get distributed more than mum, and you might distribute to a bucket company, and you might distribute to the kids. And there's a secret sauce behind how you do that. The problem is if you don't do your trust minutes, which is just a 1 or 2 page document that says, I will send this much to dad, this much to mum, this much to the bucket company. Essentially, the ATO can come back and say, well, you didn't do your trust resolution by 30 June. We're going to do it for you.
Yes.
And if we're going to do it for you, we're going to do it so you pay more tax.
Yes.
And then you're totally screwed. And if you've got a family trust with significant profits, that could be massive because what's the largest marginal tax rate right now, Russell?
Yeah, 47.
Yeah, so 47. So if all of a sudden you've got $500,000 worth of profit coming in out of your business, you could be up for 200 odd grand in tax.
Yes.
Which could be far in excess of what you'd pay at a company is now 25. Is that right, Russell?
Yep. Spot on.
Yep. So you could be paying 48 cents when, if it had been distributed to your company at 25, that's a massive difference on $500,000 worth of taxable profit, or $1 million if you've had a big year and you've had to sell a lot of assets. So it's not a small problem for people if they don't get that done.
No, that's right. And the other issue with that is obvious as well. These things are never done in a very quick time frame. So the ATO might pick this up 2 or 3 years after the fact. You might be non-compliant for a longer period, and they're looking at a number of different years. The other issue that you have in states like Queensland as well is what have you done with the money? So one of the things you might have done is you might have used that bucket company for a few years and bought an asset in it. You're now being assessed as if you're individuals back in the original trust. You don't want that asset in that entity anymore. You might have capital gains. You might have other taxation issues actually to shift it, stamp duty itself. So over time, if something is picked up and the ATO correct it, it always has these other ugly issues attached to it to actually unwind that, the knock-on effect to unwind what's happened with those dollars and everything since.
And then that can put your long-term plans in serious jeopardy if you've got to unwind that problem.
Agreed. Yes.
Yeah. And also, we don't want to have a little red flag flying at the tax department saying, hey, check out this people again. You don't want to be on their radar, do you?
No, that's right.
Yeah. Awesome. Russell, that's been fantastic, mate. If I had to say to you, what's the number one tip you'd give people coming up towards the end of financial year, what would that be, mate?
On tax planning side, concentrate on the rate, not the dollar. All my clients will be sick of me saying that. But concentrate on the rate, not the dollar. So if you're paying tax on a very large figure and it's only at 20 cents in the dollar across all your distributable entities, that gives you 80 cents in the dollar. Then the question you need to ask is, can I use the 80 cents in the dollar that's left for anything that I want? So can I do anything I want with it? Pay debt down with it, buy something in a new entity with it, put it somewhere else, gift it to somebody. Can I do anything I like with it? If you're structured in that way, then the size of the dollars shouldn't matter.
That's sage advice. That's not advice. That's just technical information, because there's nothing we've said today that should be taken as tax or personal advice. But no, I think that's a really important point, Russell. And some of the best advice we can give people needs to be repeated multiple times. So don't stop doing that. Russell, where can people find more about you online, mate? Just
Google is the easiest. Just Google Russell Strack. You'll probably get the podcast first, but then I'm at Findex. So my email is russell.strack@findex.com.au. That would take you through. Now, the last question I like to ask everyone, and we asked a different question last time, so this is going to be the first one for you. But Russell, you're over, let's just say slightly over age 50. If you could go back in a time machine and go back to, say, late 20s Russell and give him some advice, what would that advice be, mate? I've actually thought about this answer. Two things which my wife would agree with. One is don't take yourself too seriously. So have a bit more fun. Ties in with the second one, travel. Don't leave it till you're older. I've had the great joy of travelling the world with my youngest daughter. I wish I'd taken the opportunity and travelled more when I was younger as well. Love it. See the world, see how different people live. Love talking to people. So meeting people in different countries, in different backgrounds, is just one of the extraordinary joys of life, I believe. I love that. And also too, traveling with family, being able to build those memories with your daughter will be absolutely irreplaceable. Money can be made. Those memories can't. And look, just as an anecdote, Russell, I highly concur with that. I had a client years ago, mate, where they'd worked their guts out to get to retirement and they'd saved up. And I remember they wanted to go on this world trip. And I said, get it done now. And they booked it in and we don't know whether we want to spend the money. The markets are up and down. We've only just retired. And I remember not nagging them, but, really, really saying, if this is in your goals, get it done now. Don't leave it. They went and did the holiday. They had the time of their life. And then when they got back, he got a catastrophic medical diagnosis and there'll be no travel ever again. And they were eternally grateful that they did it while they can. So I think there's two sides to that. One is create the memories. They're far more valuable, in the relationships and the connections with family, but also two, we just don't know what's going to change in the future. I had the terrible occurrence to have to go to a funeral yesterday of a lovely gentleman who was a client, but also an accountant for a long time. And his great hobby was flying. And the start of the funeral was a jabberoo to a mountain. I've forgotten the name of it now, him being the pilot on the plane. They just played the video of the flight. And to look around the room at everybody just smiling on a very sad occasion, but, everyone that flew with him that I met at the funeral, who I didn't know because he's not from here, from a fair way away, and everyone who had been on the plane with him will always have those memories too. So it extends further than your direct family as well. What a great legacy to leave, to a very quiet, unassuming man who just loved to fly. Yeah. Well, I think there's some sage advice in there. Don't take yourself too seriously, but take your bloody tax planning seriously. Yes, agreed. Awesome. Look, Russell, I know we're coming up towards the end of financial year, so you're a very, very busy man. So I promised Marianne, your assistant, that I'd have you out within the time frame, and I think we're just a couple of minutes over, so we better get cracking before Marianne finds out. Really appreciate your time today. There's been some great advice in there, and look forward to the next time. Thank you, Ben. My pleasure. So now, before we go, just a couple of key points I want to make, and I might be doubling up a little bit here, but I think it's important, or I think it's
these things that were striking to me. Number one, consider contributions to super, but get advice from your financial advisor or accountant on how to do that in the best way. But you need to think not only about tax, you need to be thinking about the long-term strategic objectives of the family. Number two, if you've got a bucket company, if that word makes any sense to you, talk to your accountant about it. You need to make sure you don't end up with a Division 7A problem. And you need to ask your accountant about that. If you do have Division 7A loans, you need to understand how they work because they come with a sting in the tail if you don't do them properly. Number three, for sales. It's not about this year, it's about previous years. And if you have had a less than ideal year this year, talk to your accountant about whether forced sales can be bought in or you can manage those in some way, shape, or form. Another one is delayed sales, making sure if you sold some grain, say last year, right towards the end of financial year, maybe the income didn't come in until this financial year. So you just need to think through that. And also to depreciation. A lot of families rely on claiming depreciation on machinery or assets that are depreciable, and those things might be running out, or you might have bought some new machinery and previously you've been able to make a big tax deduction for that. In this year, you may not be able to. So you need to check that with accountant. But overall, my one bit of advice before you go is have this conversation with your accountant, whether you've had a good or a bad year or in between. And when you go in there, make sure you've got a really clear vision of the future. What's my strategic plan? Where are we going? What's going to be happening in a few years? And make sure you articulate that to the accountant. And those things could be succession related. It could be expansion related. It could be debt reduction related. There's a whole lot of things that could be coming up in the next couple of years, like replacing machinery that needs to be, discussed to be able to work it out. And as Russell said, the number one key point was it's the average tax rate you pay. What's the percentage, not how much you pay. And sometimes you've got to pay tax to be able to get ahead. So that's it for today. If you know someone that might really enjoy this podcast or might need to hear it, make sure you share it with them. That's how we get the wealth and wisdom out there. And we really appreciate everyone that's doing it. More and more it's happening every day. So that's it for me. If you've got any questions, drop me an email, ben@thefinancialbloke.com.au, and we'll see you next time.